To assess the emerging investment platform landscape, I would like to invite Sandeep Gupta. Sandeep is a serial startup entrepreneur and most recently co-founded Bhive Alls and Bhive Fund. He's a blockchain enthusiast. He has worked with marquee companies like Britannia, TOI Group, GMR, to name just a few. He's a CFA charter holder and a CIPM professional. He chairs the Public Awareness Committee as a board member and is an active volunteer. Over to you, Sandeep.
So thank you so much, Megha. I hope I'm audible for everybody. Okay. So we've got a good day ahead for us, and unfortunately with sessions like this, we've only got 4 or 5 slots. But believe you me, the kind of topic this is humongous. And there are sessions that you could do 20 sessions on this topic that will also fall short. So my role today is to kind of gist everything in together and give you a complete bird's eye view of the entire landscape today. So I hope I can do justice to this job. And thank you so much for coming over here on a Saturday morning. Great to see a full packed house. So without further ado, let me just get on to the meat of the topic. So what are we talking about today? We are talking about investment platforms. There's a lot of confusion in the market. When someone says startups, they confuse it with FinTech. When someone says FinTech, they do not understand the intricacies of FinTech. FinTech itself has 8 to 10 humongous branches in itself. And wealth tech is only one layer of that. It is also called investment tech. And within wealth tech further, you have things like, new age brokers, who are the most popular today, like Zerodha and Grow, have got the largest market share today. You have robo-advisory. While in India it has not picked up too much, but globally it's a very big play. Names like Robinhood would come to your mind. You have new age investment platforms, fractional investments, money management apps. Lots of it is there. So what we will do today is we will try to understand each of this. There are some case studies coming up that will give further details of this. So this is a very crowded slide, but the reason I put it as like this is because to give you an understanding of the scope of the fintech space itself. So within fintechs, you have something like payments, which again, you have the Paytms of the world, which started way back, almost a decade and a half back, and the journey of that space till today. You have investments, which is what we are going to be talking about today. And then you have insurance, you have lending. So imagine within lending, you have 4 different subsets. You have lending marketplaces, you have consumer lending, you have SME lending, you have P2P lending. So there are so many things in lending itself. There is underwriting there as well. There is financial inclusion, there is neo-banking, there is embedded finance, there is RegTech, and then there are the enablers. The reason I put this slide up here is to show you the humongous depth of this market, and today we are only going to be talking about this small sliver of space that is there. Just to give you these quick snapshot view of the different prominent companies in different spaces. So these are common names in different spaces that we know. We will probably be covering only this sliver of it today. Now again, when I talk about wealth tech cannot exist in a vacuum. Over the last couple of decades, a lot has happened in the ecosystem that has enabled these wealth techs to reach where they are. So while the first 7 of these are the real wealth techs, you have the wealth tech platforms, wealth as a service, alternate investment platforms, social trading platforms, robo-advisories, and foreign investment platforms. These platforms are just the public face of wealth tech. Behind them, there are so many different enablers to this industry. Things like custodians, depositories, technology solution providers, KYC, AML providers, account aggregators, robotic process automation providers, analytics, credit rating agencies, asset management companies, stock exchanges, commodity exchanges, and of course, last but not the least, the government bodies. So for all of you aspiring to make a career in wealth tech or fintech, these are all areas that you can look at, and this again is a very crowded slide, but this slide is not just about the fintechs, it is about the entire ecosystem providers that provide power to the wealth tech space. In fact, without this ecosystem, the market would never have evolved. So if you look at 2 statements from the biggest discount broker and one of the largest startup founders in India today, which is Nitin Kamath of Zerodha, he said it took him 6 years to build a base of 60,000 investors. And he had to send a document of 40 pages for physical signatures for his customers. But over the next 6 years, he has built 1 crore investors out there. So that is the power that is kind of coming in. And these enablers of the ecosystem are very important to understand that. And of course, government initiatives are very critical. The first one, of course, is something which is happening globally, which is connected mobiles. Everything is moving on to mobile phones today. So that has really helped the entire FinTech and the WealthTech industry. But beyond that, Indian innovations like Aadhaar, your UPI, your account aggregators, which is your connected bank accounts, are very unique to India, which has given good impetus and made India a leader in the world. So it is not just India following global companies, but India has the potential to do something that globally people cannot do, because our government has put in the infrastructure which no other country has today. Again, this is a landscape. We have discussed this in brief. You have the robo-advisors. These are some of the prominent names over there. You have micro-saving apps, fractional investment, new age platforms, cross-border. So sitting in India, you can actually invest in global stocks through Vested and Stockall. Then you have the domestic discount brokers out there. And globally, again, it resembles, but because of the different ecosystems in different countries, there may be a slight difference in character on these cases. So what is the relevance of these platforms and how is it important for retail investors? So what are the benefits that these online platforms can do that the traditional business cannot do? My apologies to a lot of traditional fund managers in this room, but there are things that digital can do that physical cannot do. Of course, there would be things that physical can do that digital cannot do. And I'm sure because my moderator is a physical world, I'm going to have a tough Q&A, but so be it. Happy to defend that. So what is it that they do? First of all is digital accessibility. Everything is available at the tap of the button. It's on your mobile, on the go, on the move. So I think that is something that is there. And interestingly, if you look at any of the banks today or any of the investment platforms, whether they're traditional, whether they're new age, sometimes the traditional players have got better technology than the new age guys. And they have all moved on to it. So a distributor like NJ, which is the largest mutual fund distributor, is completely online as well today. All your ICICI Directs or Axis Directs are all online today. Some of their technology even beats the fintechs. So this has really, really helped the ecosystem for digital accessibility. Real-time data. You have complete visibility on the go, in a travel, on a commute, on what's happening to your portfolio. Sophisticated tools. The algorithm-backed databases and the processing of that can give you really, really good insights on various aspects which was not available earlier. And finally, the most important part which has led to the success of these platforms and helped them expand the retail investment market itself is cost effectiveness. Because we all want the best services at the lowest prices, and only technology can do that. Some of the pricing of these platforms looks too good to believe, but imagine the kind of profits a company like Zerodha has made in the last fiscal, which is roughly around 3,000 crores. So that is the kind of profits they can make at the low fees that they have. But how do they do that? They do that by achieving scale, and scale can only come through tech. Okay. And what is the benefit to society? So while it's all good, we've got good things for, the common people, but what is good for the larger public at large? What is the benefit that these platforms are giving? So the most important thing that has happened is there's a lot of financial literacy that has happened. And there is a lot of inclusion that has happened. I have stats coming up in the next few slides, but multiple of those slides say the same thing. Because of these platforms, the demography of investors has changed. Today, you have college students having demat accounts, which was never the case earlier. You have women participating in diversified investments, products that they would have not known earlier. And finally, what also happens is democratization of investment. Things that are esoteric to the common people, something like commercial real estate. How would a common man invest in a commercial real estate worth 50 crore rupees? How do you invest in commodities? You would not even have thought of these things. How do you invest in US stocks? So a lot of things that were never in the reach have now been democratized by these platforms and brought within the reach of the common man. Customization, again, we will have a debate on this, Megha. When we have the customization, is online better or is offline better? Definitely, I would say offline is better. I accede to that. But for whom? See, when you spend your 1 hour of valuable time with a customer, he better be giving you at least 5 crores of assets under management. Otherwise, it's not worth your while. But here, technology can provide not exactly the same, but a little compromised experience, but for the mass affluent segment as well, or even at the lowest segment as well. So that is where customization helps. And transparency. Here is again a very interesting topic, because transparency and regulation is something that really affects the fintechs today. And we all know what's happening in the news. But believe you me, a company like Paytm is out there in the open. If they don't do their KYC, they are caught. There was a news article of someone saying, if the RBI clamps down on the smaller PSU banks today, they will be in a worse situation than a Paytm. At least with these online platforms, you know what you're getting. There is transparency, they cannot escape. So that is something that comes, which are the benefits of these platforms. Again, I've discussed some of these. Fintechs help move. They have actually helped move the investor base from the metros to tier 2 and tier 3 cities as well. The demographic profile earlier used to be middle-aged people, financially savvy men. Women were never participating, students were never participating, the younger generation was not participating. So believe you me, my son has a Demat account today and he's in college and he is doing trading. He doesn't have much money, but the kind of knowledge that he's getting by losing 5,000, 10,000 rupees is giving him exposure to the cycles which will stand him in stead in the future. So the demography is coming down, more women are investing, and the kind of investment corpus you need to invest in these assets is coming down because of these platforms. So these are some random stats over there. So Paytm Money has 60 to 70% first-time investors. So they are opening up a brand new market, and if these investors come early on board, you know, the power of compounding starts happening for them. They have 80% of millennial customers under 30 years of age, and a very good significant growth in women customers. So these are some of the things that these platforms are doing. And what some of these platforms have also now evolved into, they've got some very beautiful mass open courses. So these courses are teaching you various aspects of finance, not just in English, but in the vernacular language as well. And how women, how farmers can save, what is crop insurance, you know, lots of topics are there that could help a lot of people in the rural areas, in the lower economic segment of the population. What this has actually done, it has changed the persona of the retail investor. So if you look, by time, you know, I'm a little old, so before the Demat had started, we used to trade shares physically. You know, you have to sign at the back, send it by courier, and it was a humongous process on that. So very few people were actually investing. Now, because of these digitization and because of these platforms, the persona of the investor has changed. The investor diversity has increased, the risk appetite has gone up, and that is also because now you can invest as low as 10,000 rupees in a startup through some of these platforms. I'm not getting into the good, bad, ugly of that. I have these panels coming up, where I'm sure these topics will be taken up in great detail. But there is a start where you can taste different asset classes which were never in your reach. Investment in private companies, investment in gold as a tradable instrument at as low as whatever balance is left over from your spend. Companies like JAR are doing that. So we'll come to those case studies later. Coming back to this, there is a lot of portfolio diversification that is happening, and there is a geographical outreach that has happened which was never there. Again, this is an interesting slide, and the next one is even more interesting, but both are linked. I will just tell you about this slide first. How do people research where they want to invest? See, till date, majority of people will ask their friends and family on how to invest and where to invest. So that is a big chunk of 73%. But interestingly, 53% people have started listening to digital influencers. Again, I'm not getting into the good, bad, ugly of these, whether they're regulated, not regulated, are they giving good advice, or is it a scam like the ZTV scam that happened recently? I'm not getting into that right now, but this is the statistics of how people research their investment thesis. And then you have social media. So you have social media that is coming up, which is also influencing, you know, these are random people. You will follow somebody who looks like a good influencer and you will look at them. And then you have digital news. And finally, you have wealth management apps right here at the end, which is a very small segment of this. But so after you do your research, what next? So here is the interesting thing. After they do the research, they go to the bank and broker or both. And a lot of these are also completely financial platforms in themselves. A lot of these transactions no longer require you to pick up a phone and call your sub-broker, buy this share, sell that share. People are doing it themselves. So that is what this has done. And a lot of people are using 1 app, 2 apps, 3 apps, 4 apps. So, those things are also started happening. So this is where the market is kind of moving. How much time do we have? So what has this done? This has also affected certain asset classes positively and certain asset classes negatively. So the big daddy of everything is always your bonds, which is your fixed income. So that is something that is still done better, and there is a lot of so the fixed deposit has actually gone down, but your bonds have gone up. So the fixed deposit is what comes into the banks. So they have kind of dropped down a bit, but what has grown up is a little bit on equity. Of course, the number of people investing has gone up. I'm sure mutual funds would be here, which is almost the same. Yeah. So it has changed the demographics of the investment profile of people as well. So there are a lot of statistics there. We all know the kind of SIPs that have started happening recently. The market has reached almost 50 lakh crores of worth of AUM, and almost $2 billion of SIPs are being received on a monthly basis through mutual funds, and so it's really giving a push to the equity markets. Again, not getting into details of whether it is good, bad, ugly, whether it is inflating the markets in an artificial way. But a lot of money has started flowing into the capital markets and moving out of traditional instruments like fixed deposits. Again, then the focus is there, and the gold market is also increasing because of digital bonds and things like that. And some pretty smart investing tools have come into the market. We have some case studies coming up, just to name one or two of them. So there is an app called Jar over here. I don't know if you've heard this name. So what they do, if you spend 81 rupees on a shop and you pay through the Jar app, he will charge you 100 rupees. But 19 rupees will be invested in digital gold for you. So it creates a habit of saving in youngsters. So whenever they spend something, whatever loose change goes, it goes into the jar of your good luck. So these are the startups that are building saving habits. So like that, a lot of innovation is coming in the market, and they are doing pretty well as well. So from this slide, if I were to look at, so the way you have the Ubers and the Netflix introducing technology in their respective area for financial distribution and for financial decision making, these apps are kind of revolutionizing the market. Again, I have discussed this earlier, so I will not repeat this. There's a lot of good stuff happening out there. There's a lot of content, genuine content, without any vested interest out there as well, and it is really helping the mass population there as well. Again, what is happening is the number of investors is growing, and the share of these digital platforms is growing phenomenally. If you look at the numbers in FY17, just 7% of the total demat accounts were with these digital brokers. But today it is 57%. And this has really, really expanded the market size. I would not say that the AUM of these investors will be large. It may be very, very little. One big investor is the pass of a bank may be huge, but this is expanding the market, and these are the investors for the future. If the youngsters start understanding how to save and how to invest properly, they will come a very virtuous cycle of compounding of their money over time. Of course, it's a little dull in the funding side, that all of us know, both on the FinTech space as well as the wealth tech space. Having said that, there are established players who have already established large platforms, and the traditional players are also now digitizing everything. So not to worry, this will always come and go. This is one of the cycles that is there. Now, this slide, you would want to ask, why have I put this slide out here? Because this is a slide which gives you the universe of assets out there. And every asset can have a financial product on top of it. Now, I'm not saying these are platforms. They're not to be platforms yet. Now, these financial products can then have participation from traditional as well as tech-enabled platforms. So, for example, if you have fixed income, you have so many different categories of financial products around fixed income. You have private equity, you have gold, you have real estate. Real estate has always been there. It's been a traditional instrument. So you have real estate investment trusts, which have always been there. In the developed markets, that is how investors invest in real estate. You have land and property, you have commercial real estate, and you have real estate mutual funds. Now, all of this in the next slide is being leveraged by different types of platforms. You can build a platform, you can identify a niche where there is a gap that the market is not being served, and create a platform around that. Things as esoteric as litigation assets, things as esoteric as painting and arts are also coming onto the market. Of course, in India, they are not very popular at this point of time, but globally, there are companies like Yield Street and Cadre that have done really well on that. So you have the aggregators, you have international equity, debt, lease financing, fractional real estate, artwork, P2P. You have all these segments out there, wine investments, electric vehicle financing, brand loyalty-based debt, angel investing. So these are things the regular person would never have invested it in the traditional way. But now you can play with small sums of money as low as 10,000 rupees and get a taste of these instruments as well. But it's very, very important. How do you assess it? As responsible advisors, as responsible market participants, we have to be very careful when we interact with these assets or advise anybody to interact with these assets. Each of them have different risk return profiles and may not be suitable for all investors. It's very critical to understand what these are, get into the details of it. The advantage that is there is people can take a small bite out of it, amount that they does not hurt them if they lose it as well. And it builds memory muscle that, hey, this instrument behaves like this. So all of us who've been in the markets know that markets go up and down. And over a period of time, you build that into your investment philosophy. We are now able to give the same experience across multiple asset classes at a very low ticket size at a younger demographic. But it's important to understand the risk reward profiles of all of these. Again, like I mentioned, there are things that were never there earlier. Global equity, you could not invest in global equity. Commercial real estate, commodities, bonds, revenue-based finance. How many in this room have heard of revenue-based finance? I would say 4% of this room has heard of revenue-based finance. There are companies that have raised thousands of crores of rupees on revenue-based finance in India. So this market is already taking off. It is helping smaller entrepreneurs. It is also kind of creating communities around small businesses as well. So there is so much happening in the market, which is why I earlier mentioned, in a conference like this, we have only 4 sessions to kind of take, but each of this is a complete section in itself, which is where I will now quickly try to cover each section with 1 slide each and quickly give you a flavor of it. So the first is real estate. Would you not want to invest in a hotel like this? Of course, you can do that through a REIT, but a REIT is a public market product. It's like a mutual fund. You have a host of assets that come onto that. Whereas in India, there is a trust deficit. Hardly 5% of India's population has ever invested in capital markets. And REITs are actually a very small part of the capital market. In India, people like to touch and feel their investments, which is where the majority of their investments is in gold or in real estate, and some of it is in fixed deposits. Because there is a complete trust deficit. They would like to visit the place. So just next door, my ex-company Bhive is there with a commercial office space. That is owned by 200 people. So they get the revenue of that space. So that is what commercial real estate can also be done. So 1 slide on commercial real estate. Robo-advisory again. Traditionally, people were doing the same thing with wealth advisors, but it is for very, very wealthy UHNIs. With robo-advisory, there is algorithm-based advisory, and it can go to the mass affluent section. So robo-advisories are there. These are some of the players over there as well. Micro savings. This is the thing I was talking about, jar. Basically, whatever the odd shopping value is there, say you spend 8,433 rupees. If you put a limit that if I spend anything above this amount, the balance up to 10,000 should go into my saving app. Whenever you're spending, you're actually saving also. Things like that will help the saving habit as well. This is called micro savings. P2P. Now again, P2P was very big in China at one point of time. We all know about it. It was a major bust as well. And of course, India has also had its own sufferings in P2P. It started in 2018. The RBI came up with regulations around it. But during COVID times, again, it became into a problem. This is a classic case study of the interplay between the market and the regulators. So what happened during COVID, the exposure of a borrower and a lender was direct, peer-to-peer, direct. So that became a big problem. So this business is nothing but what banks do, the spread between a loan and a deposit. So now what the RBI has mandated, it cannot be a direct exposure, it has to be in a pool of assets. So even if some of those go bad, there is some return that goes to the investor. But that's how, there is a slide on regulatory also coming up, but P2P is also a very big potential segment. It can replace fixed deposit and loans completely, which are currently in the control of banks. And why should you give that kind of spread to banks where you can directly interact in a community-based peer-to-peer lending as well? Again, this is a little esoteric. Litigation funding in the US, it's taken off in a big way. There you can actually fund litigation cases and you get the returns based on the outcome of that litigation. Startup investments. So startup investments were always with institutions, alternate investment funds, while you did have category 1 funds as well. There also the minimum ticket size used to be 5 lakhs, 10 lakhs, with an aggregate investment of 25 lakhs. But now there are companies that are bringing this down. Using Cat1 route itself, they are able to diversify the number of investments you can do because they are using technology for that. Otherwise, managing the system becomes very difficult. And startup investing is like, it's got a very high kurtosis and skewness. It's not a normal distribution. If you have 100 companies, 2 of them are what are going to give you the returns. But if you've got a 25 lakh investment corpus, you can only participate in 5 opportunities. So there are new age platforms today that you can invest in 10,000, 50,000 rupees and invest in diversified portfolio of startups, which is the right thing to do for startups. Because there, you will then get a 40% IRR across your entire portfolio of investment. So that is a classic case of, how new age platforms are kind of diversifying the investment opportunities for investors and de-risking as well. Again, this is an interesting new thing that I don't know many people would know or not know, but you can actually invest in pre-IPO equity as well. So people are creating platforms for this as well. The legality of that, again, I'm not delving into the depth of it because, all of these platforms have taken legal opinions, but the government can come and clamp down on it as well. It is always a fight between the innovator and the regulator because it's always a balance. If the regulator is lax, then there could be accidents and there could be people suffering because of that. If the innovator is too strict, the innovation will never happen and the entire innovation ecosystem will move abroad. Again, AI is all the talk of town today, and a lot of new chat GPT plugins are available for various things. People are using it for various different types of stuff, and a lot of changes will happen because of this as well. Again, coming to the regulatory part of it, what the government of India then did, some of the interesting things like, I will talk about MSME REITs and P2P. I already detailed the P2P story. MSME REITs is a new regulation that is yet to be notified by the government, but that is for fractional real estate. So it is kind of a new regulation coming up. The government has said, okay, now this market has built a 4,000 crore worth of market size. Now is the time to step in before accidents can happen. So which is where they have notified the MSME consultation paper. Of course, it's yet to be notified completely. So these are also things that are there in the market. Also, what the government has done is they have opened up GIFT City or IFSC at GIFT City in Ahmedabad. This is basically to onshore the innovation that was running away from India because of the strict regulatory norms. So they have a unified regulatory body out there which gives you a single level approval for the various licenses that you need. They have a sandbox mechanism there as well, where you can try, test, do your innovation, see if it works, does not work while it is small. And if it is a workable solution, the effective guardrails will be put in place and then you can scale it up as well. So the government is cognizant. The government is also watching what is happening. They are not completely clamping down on everything, but they give a little bit of a rope because the government has a tough job there as well. Like I mentioned earlier, if they leave it loose, people can get hurt. If they keep it too tight, innovation will die. So regulators continue, these are the future trends. Regulators are very worried about investor protections. That is their job and that is what they're doing. So that is something that is interesting to look for the future. There is investment in wealth tech, which is opening up new and esoteric asset classes for the general public. There is a growing focus on technology and innovation. And of course, there are new technologies out there as well, like AI, blockchain, decentralized finance, and other things. Now, again, technology is not bad or not good. Technology is like it's like a new knife in the market. If you want to cut vegetables for it, you can do that. If you want to murder somebody, you can do that. So that is where the regulators have to come in and ensure that this technology is properly utilized for benefit, not for harm. So that's about it on the slides part of it. Happy to take questions. Oh, absolutely. So each of these have their inherent opportunities and challenges. And like I mentioned today, if you look at fractional real estate, there will be around 8 to 10 companies in the market. Each of them have different ways of operating. Some are using private structures, some are using LLP structures, some are using custodians, some are not using custodians, some are using trustees, some are using AIF routes. So there are multiple routes for each of these platforms. Because these are new products, we have to be very careful of which product are you signing up for and how is that product kind of dealing with its investors. There is no one size fits all at this point of time, which is where SEBI has come out with this paper on MSME REITs to bring everybody in the fold of regulations, and then everybody will have to adhere to the same thing. Once that happens, there would be secondary exchanges out there definitely, which will become, from real estate, it becomes a financial investment in real estate. So that is the journey that has to be traversed. Early days, 4,000 crore AUM, yes, it has been created by this clutch of 8-10 companies out there. But in terms of liquidity, there are different people following different things. For example, PropShare Capital, what they do once in 3 months, they do a kind of a festival wherein they will open up shares for trading, and it's a bid-ask spread matching at that point of time, as good as a secondary market trade. So that is one way of doing it. Others are saying, you have lock-in, you cannot withdraw, but on an exception basis, if someone really needs their money back, what they will do is they'll shift it to some new investor coming in, and then they could be kind of see, the price discovery is where the challenge comes. With developed equity markets, the price discovery is happening online through technology. But these are not really developed, so it will take time for that scale to come, for more players to come. There will be market makers coming into the game, people who are earning the spreads between the bid and the ask, and have the holding power. So there are a lot of things that will evolve as it happens, but this is the first step for making these investment classes open to the. I hope that answers the question.
So Sandeep, thank you so much for setting the tone for the day. And I truly agree that what physical infrastructure in this space can do, the digital can't, and what digital can do, the physical outfits can't do. However, having said that, I totally agree as far as your point on financial inclusion is concerned. But my question stems from the fact that I think we all would agree that financial literacy in India is very poor. And as a wealth management professional over the years, we have often seen clients either grossly underestimating their risk appetite or grossly overestimating their risk appetite. What I would like to understand from you would be that most of these platforms typically have algo-based suggestions. Now, how do you ensure that you understand the customer or the investor in entirety, their objectives, their constraints, so that there is not a wrong product fit for the investor?
Absolutely valid question. And the space that you're coming from, I totally agree. See, because what happens? Now, suppose there is a 22-year-old and he's just started his first job. What will he do with his money? He will start blowing it on, all kinds of things. Now, imagine a jar coming in there, taking a slice out of his spends on every spend that is happening. And over a period of time, you realize by the time he reaches 25, 28, 30, 35, that becomes a significant corpus. So while the algorithm is there at the back end, there could be certain leakages as well. But the amounts that we are talking about are not humongous. They're not large. And a client who's going on to these platforms is not a wealthy person, because, the wealthy people have their own set of access to more sophisticated advice. They will call a wealth manager or visit a wealth manager and take that advice. But there is a huge demographic that never had access to this, and that is the demographic that is being exposed to multitude of products. So during our generation, how many of us had, stock investments? But today, if you go to any college, every student has got an investment in stocks. And while they have very little corpus as well, they are experiencing the cycles. Like everybody is on a high right now, markets are on a high. When the market is going to fall and the pain is going to happen, that is very, very valuable, more valuable than the money that they may have lost. It is giving exposure to a wider swath of people in my opinion.
True. And, I think you're right, because in a traditional form of investing, what would typically happen is that there used to be an interpersonal connect between the investor and the, advisor. And the advisor would typically play a role of a realist in the room. However, with these platforms, and as you very rightly pointed out, that in the last 3 to 5 years, when these companies have actually gained prominence, it has also been a time of a very unidirectional rally as far as the market is concerned. Now, do you think that when the tide corrects or changes and, probably there are negative accidents along the way, these investors, because for the use of a better word, lack of appropriate knowledge or not having witness, not having some kind of hand holding, they may exit investments at a not a very opportune time. Now, do you think that this would kind of hinder the wealth creation process in general? And if so, don't you think that they go back with very poor experiences at the very start of their investing journeys?
It's a very valid point. In fact, this is the typical story of stock market investors in India. They always enter at the high and exit at the lows. And a prime reason for that is nobody is hand-holding them to tell them that, boss, you hold it. This is not the right time to sell. You have to sell it when it is on a high. But if you don't have a personal advisor, this always happens. So that is something that is definitely, I agree to you. But honestly, if you ask me personally, I would rather have my kid lose 1 lakh rupees of his hard-earned money than lose 10 lakh rupees at an age of 35 when he would start getting into the cycle. The pain can be borne at a younger age. And that is something that they will have to experience. It can never be taught. Unless until you bear the pain, you don't understand what you're getting into. Even any fractional real estate platform or any other investment for that matter, if the proprietor is not, not correct, or if there is some mischief, anything can happen, because some of these platforms, yes, may be unregulated as well. So there could be certain people who would want to take, advantage out of it. But the benefit that is happening is you are not investing large amounts there. You can start small as well. And that is what all investors, prudent investors do. If it's a new product, they will not put significant part of their savings in it. They will put small parts of their saving, observe it over time, and get an understanding of the space. Startup investments. How many people in this room have startup investments? Raise of hands. So few. And any reason why you're not investing is because you have to commit minimum 25 lakh rupees to a Cat 1 AIF to start investing in startup investments, or get as an angel onto friends and family, which is more by force than by choice, if you ask me. But imagine the same startup investment, if you can do it 1 lakh rupees or 50,000 rupees, would you not want to take a bite and see what's happening? And even if you lose that kind of money, it is not hurting you. So that is what these financial platforms are able to do. Yes, one way of doing it is have a very good advisor who tells you all the risks and pitfall about startup investments, X percentage of startups fail. It's a very high risk business. Some of these will give you very good returns, but till you don't experience it, till you don't lose your money in 4 or 5, or you gain your money in 1 or 2. And honestly, even if you gain your money in 1 or 2, like a Zomato early investor, he will be totally biased towards startup investment. He might then put all his money into startup investments and tell his friends and family this is the best thing to do in life.
Right.
Because he has won the game. But that's like a lottery ticket. And unless until you experience 4 or 5 falls and then one success, then you are able to get a better idea about the entire asset.
So I think the point that you're trying to put across is that maybe, as people who are parents in the room, or there are so many youngsters, maybe have a risk capital assigned to it and maybe take smaller bets before you learn, and before there is a learning curve associated with it.
It's a natural process as well.
Yeah,
it typically happens. Even the day traders that came in during COVID, a lot of them burned their hands and will square off day trading now. But better early in your career than later in your career.
Totally agree. Because so my next question is, of course, the talk of the town, the regulation. So, there's a constant tug of war between the regulators, be it the RBI, AMFI, IRDA, so on and so forth, and the companies in this space. Now, what the regulator typically believes, as is kind of evident from the statements they release, that while they're kind of following the regulatory framework, but it is more in letter and not in spirit. Whereas these companies feel that they're kind of stifling their growth very, very significantly by virtue of coming up with, very sudden and abrupt regulations overnight. So how do you see the overall ecosystem where there is going to be a continuous lack of trust and comfort between the founders in this space and the regulator?
Yeah, I would say it's an evolution. So the regulator's key responsibility is to protect the masses from, accidents to happen. So they will definitely first say no. But the good thing about Indian regulators today is they are not behaving like that. They are initially giving a little bit of a leeway for the play to develop to a certain extent in a very small scale, so that the impact, if any accidents, is to a very small extent. But the time that it starts expanding and growing, they bring proactive regulations into the game. Now, these proactive regulations are very good from the regulator's perspective, but from the startup's perspective, they will feel it is stifling my innovation because they will get affected. They will have to, business as usual gets disrupted for them. And they say, hey, why are you bringing these new rules? But this is also important. These guardrails are also important. So this is a constant fight. It's a very important fight for it to always happen. It's a natural evolution that it should happen as well. And it is happening as well. So that is my take on regulation. I hope I had a little confusing answer, but did it make sense?
Are you of the opinion that, the innovation should continue and the regulation should follow?
See, there are different approaches that you can take on this. But I'm of the firm belief regulations are very close to innovation. No innovation will happen. So they should give the benefit of doubt at a small scale to the startups. Otherwise, the innovation will totally get stifled. But the moment it will affect the markets or a larger swath of consumers, they should definitely observe what is happening and then bring in the positive regulations to streamline the risk. Peer-to-peer lending is a classic case.
Right.
China didn't have any regulations. Market boomed, and people were saying, hey, China has got. So in India, it was not allowed at all. But then, they wrote these papers. The RBI came up with a policy which was stifling to a lot of players. The other players kind of navigated around it and built their AUMs in that. But then again, that was not sufficiently stringent regulation to deal with a black swan event like COVID. Again, there was a lot of pain in the market. But again, the regulations evolved to kind of make it better. It's always a continuous and it's a new thing because, so if you really look at I'm going a little historical and a little philosophical here. So the innovation has always happened. So do you know when was the first joint stock company that was formed? 1600. That was the first time people could pool their capital together in a joint endeavor. And the endeavor was for having ships from Europe trade with Asia, China and India for spices, silk and other things. Right? And that led to the most valuable company in history. If you inflation adjusted, it is still larger than any capital market company today, which was the Dutch East India Company. So if you inflation adjust the valuation of Dutch East India Company in somewhere in the 1530s, it would be bigger than any of your, Teslas of the world or anybody else. But that was innovation. So that was innovation. But then what happened? The reporting was not that transparent. So then what happened? Then they had to have different types of regulations coming in. Reporting had to be brought in. I'm sorry, I'm feeling Mr. Dhuri's thing as well because we were just discussing some of this before. But I have the same view that you have audits coming in, you have quarterly reportings coming in, you have so much of stuff happening, public markets, IPOs. So it's a continuous regulation that keeps on coming, and then a smart. I'm not calling him an entrepreneur, but not to defame entrepreneurs, but a smart player or a bad actor in the market will want to play with something and create wealth for himself or herself. Then again, regulation will have to come to control that. So this is a continuously evolving thing.
Sure. So I think what I take away is that, there has to be a lot of collective responsibility that we as finance professionals and a lot of institutes take to probably impart education on financial literacy very early on, in the lives as students. I think that is definitely what is missing. And if all this has to probably take off so that, mistakes are minimized, there is a collective responsibility that we all have together. So there are some very interesting questions from the audience. And so there's a question by Vivek. And there is also a question by Harsh, which I would like to combine. Vivek asks, why do you think robo-advisory hasn't taken off in India? And I would like to combine that with the question from Harsh, which is, how do you expect the ratio of AUM to be between the wealth tech and traditional players in India?
Sure. So I don't have these figures off the top of my mind. So apologies for that. But yeah, So my perception is robo-advisory is very big globally. You have the big names out there. In India, you do have products like mutual funds and others, script boxes of the world are there. But I haven't seen it become as mass market as some of the other things in India, because I still feel India is a market that requires a face-to-face interaction. Also, the slide that I had shown, that how do people do their research. So robo-advisory was not one of the platforms that came up. How people do research is also, a point that I would look at on why robo-advisory has not taken off, but happy to be corrected on that. And there's a lot of innovation happening, and globally it is very big. Why not in India? But in India, I still think people want to talk to somebody before putting their hard-earned money. And while they have got comfortable with certain asset classes, robo-advisory is also something that may have taken off, but I'm not too aware of too much of that happening.
So we'll take one last question, because, I for sure know this is Sandeep's, interest areas. And the question is, how do you see blockchain solving the trust deficit problem and your views in it?
So again, I'm stealing from Mr. Puri's session. There's a complete session on tokenization coming up. So tokenization, sorry, I'm taking this up, but this is what I'm doing. So tokenization versus crypto. Anyone in the room, of course, we have experts like Kashyap here as well. So what is blockchain? Blockchain is a technology. It is like a knife. A knife can be used, or a sword can be used for anything, right? What do you use it for? So cryptocurrencies is a great concept brought into the market to alleviate certain problems in the market. What are the problems? The governments have been taking the currency off the gold standard and are printing currencies left, right, center. So they are actually stealing money from your pocket. Why should you allow them to do it? So that is where cryptocurrencies came, and they control the money printing system, which is why they can do it. So here is somebody, a bloke who nobody knows who he really is, came out with a technology with certain inbuilt safeguards. I'm talking about Bitcoin here, wherein nobody controls it and everybody controls it. It's absolutely democratic. And having studied this space for some time, I am completely confident in the technology part of it. Am I saying this is going to be very, very popular in the future? I have my own thesis. I'm sure there are some crypto investors today, crypto is at an all-time high, they may differ with me. But here is where I come in from. I'll share my views on this. I think it is like the pager before the cell phone. So the pager technology has been used for the cell phone as well. But this is the pager technology. It's very useful. You are on the move. Anyone can contact you or ping you. You'll have to call back from a physical line, and they will then get in touch with you. But it's so useful for people on the go. But what happened when a cell phone came in? The cell phone has all the features of a pager plus more, right? So the technology is great, but these technologies have created a $2 trillion market cap of cryptocurrencies out of thin air. Just to put this number in perspective, the valuation of total gold ever mined in the world is roughly around $15 trillion. So imagine how much of gold has been mined in 15 years out of thin air. And why is that? Because people need a store of value which is accepted by other people across jurisdictions and don't have any custom controls. Of course, this creates problems for governments. They lose control over a lot of things, So they will definitely oppose it. But a time will come when the government will have to stop minting money like it's their money. No, it is not their money. It is the people's money. How are they printing money without your permission? Because they can. So of course, there's a lot of evolution that will happen. This is a subject matter. In great detail, we can take it up. Governments are coming up with CBDCs with different types and flavors of that. Central banking digital currencies. How is it different from a digital wallet? It's still to be seen. Is it going to be restricted number of issuance? Who has the right of issuance? Different governments will have different CBDCs, all on blockchain. This is all blockchain technology. So a lot of evolution will happen. So it is not just people or who are bad actors. Sometimes governments are bad actors as well for their own purpose. So this is a technology that gave rise to a $2 trillion market cap of a set that has kind of created, taken power away from the government. It's democratic, but there are negatives to it. A better solution is required, definitely is required. And Mr. Shailesh Dhuri is going to speak about it. It's got a full 1 hour session on it. I'm not saying that is the solution, but that is one of the solutions. Every solution has to be evolved. It has to hit the market. It has to see how it comes on. Again, I think it was a little confusing.
It was. Okay, I think in the interest of time, I will not be able to take any more questions. Request you to please interact with Sandeep offline. Thank you, Sandeep, for a very enlightening session.